Hello, and welcome to Credibly Challenged. My name is Matt Bisanz, and I'm a bank regulatory partner at Mayer Brown. Credibly Challenged is a podcast series on bank risk management practices, and today we are joined by someone who has a great broad view on what banks are up to. Ethan Heisler is the editor-in-chief and founder of the Bank Treasury Newsletter. He routinely engages with banks of all sizes on the core issues to their operations. Today, we're going to talk a little bit about some things he's been seeing in the market recently. But first, I want to thank you, Ethan, for joining the program.
Thanks, Matt, for having me.
So one thing that we talked about in the pre-session that I think is really interesting for audiences is about the Federal Home Loan Bank system. That it's this sleepy, poorly known copy almost of the Federal Reserve System, but it is not the lender of last resort, even if it does lend to banks on fairly generous terms. What are you seeing as far as lending in this market?
Well, it's funny, Matt, that you say it's the sleepy version of the Federal Reserve, since it was started, and many people don't know this, by Herbert Hoover in 1932. So in its purpose grew out of the Great Depression and the failure of many banks to help financial institutions to provide mortgages to or provide the financing or the liquidity to banks to support the mortgage market. And that has always been its core function all along. Um, I have never heard the Federal Home Loan Bank until just recently being referred to as some sort of like lender of last resort in a would-be sense. I've never heard of financial institutions actually trying to approach the Federal Home Loan Banks for that purpose. Generally, banks approach the Federal Home Loan Banks for interim financing. So my deposits are running a little light compared to where I could borrow some money in the wholesale markets. Let me take advantage of the home loans and use an advance here, which will bridge until deposits grow and I have better longer term financing options. It's important also to understand that the Federal Home Loan Banks are one of several tools that a bank treasurer has in in financing his balance sheet or her balance sheet. In addition to this, banks have been using brokered CDs. They have also could raise deposits through targeted deposit raising in certain markets with certain the point is,
Yeah.
there are one of many.
Mhm.
So I think it's very important when people talk about the Federal Home Loan Bank system, they say, oh, they're these weird lenders of last resort, and where they come to this conversation, to understand that they're part of the operational toolkit that is used to run a bank balance sheet, to do the asset liability.
But they did, if I'm not wrong, get a lot of coverage after the failures of the banks in 2023, when
Oh,
some
and
of them, when
also
those,
back in the financial crisis, they
right.
had advances to Washington Mutual. They've had advances to IndyMac. So the
Mhm.
conversation is not a new conversation in 2023. It goes well back to the financial crisis, perhaps before that, but definitely in the financial crisis because they figured that way. There's always been in the banking industry um, a view of the Fed's discount window as attached as having a stigma, and in a industry that is so dependent on public trust, even the hint of uncertainty about viability is enough to cause the very thing that you wanted to avoid. So banks have always been looking for ways to quietly solve a problem if it's a short-term problem. Um,
And also they have the
I
benefit at the FLIBs that it's not public in the same way now, at least after a couple of years, discount window borrowings become public.
Right, that is true, but neither is borrowing from my bank if I'm a corporation today,
Mhm.
public. It is a bank.
Mhm.
And importantly, the Federal Home Loan Banks are joint and several. So
Hmm.
they have a preferred ability to raise money as a federal agency like Fannie Mae and Freddie Mac, and
Hmm.
so they get a preferred rate that way and can provide that to their members. It is a cooperative, however, so and therefore owned by the members of that home loan bank.
Hmm.
Um, I don't think we have time to really
No.
go through the whole structure of it, but my point was that its role as lender of last resort has never really been a topic. It's
Hmm.
being labeled that way. And I think it's important to understand two things. The federal home loan banks can provide financing to their members during business hours. The federal home loan banks are not available to provide financing to their members at midnight or on the weekends.
Hmm.
So if we specifically refer to Silicon Valley, to Signature Bank, and the failures of those institutions around basic operational governance. So have a working line with the federal home loan banks, have working lines with the Federal Reserve, have ability and other backup means, have a contingent funding plan. I mean, all those
Hmm.
things that they lacked
Hmm.
would still never have saved them if they needed to come into the Federal Reserve or the Federal Home Loan Banks seriously at when they were actually failing.
Hmm.
That everybody has understood this. They do believe, and there is a general view, that banks simply relying on the Federal Home Loan Banks to plug big holes, that needs to be more clearly understood. We're
Hmm.
not here, Federal Home Loan Banks, and by the way, neither is the Federal Reserve under Rule 10B of the Federal Reserve Act. Neither of these organizations provide liquidity financing to failing members.
Hmm.
That's really not what they're supposed to do. The problem comes down to when is somebody looking for money and they need some help to get over, they need a little bit of an assistance and they'll be
Hmm.
fine.
Right.
And when are they literally failing and you could throw them a life preserver, but they might as well be throwing them an anchor.
Right.
It's not going to help.
Right.
And the federal home loan banks historically before the financial crisis actually used to have bank examiners,
Hmm.
and they were not good at examining S&Ls.
Hmm.
That's why
Hmm.
they got out of that business.
Right.
And I think there's an institutional reluctance on the part of the federal home loan banks to get back into the business of say, oh, I need to assess a member and whether that member is a viable, is it borrowing money because it just needs money
Hmm.
operationally, or is it borrowing money because it's going to fail?
Hmm.
Um, Unfortunately, we've in this clickbait type world that we live in,
Hmm.
we've we've sort of shrunk the issue down to a really irrelevant. The As I said, the
Hmm.
the home loans cannot be a lender of last resort, and the
Right.
Federal Reserve really can't be a lender of last resort because it doesn't have to lend money to a failing member.
Right. But now the Federal Reserve has an idea that at least I've been hearing about through different industry channels that there may be a proposal in the next few months to require banks to pre-position collateral at the Federal Reserve with this idea that there's this small runway of when a bank encounters difficulty to when it becomes failing, maybe something like 5 days. And if there was enough collateral at the Fed during that 5 days, you could turn the ship around before it sinks. Am I describing that idea that people have been kicking around, right?
Yes, absolutely. And like all good ideas, they sound nice in principle. The reality of them becomes what I just said before. The home loans and the Federal Reserve are not open for business after hours.
Hmm.
So at the Fed wire is the only time that the Federal Reserve could actually provide that liquidity funding, unless they change the operations, which I haven't heard any serious plans about. Michelle Bowman, in fact, talked about that in some speeches that she made last month that I quoted in my newsletter.
Hmm.
Um, I I think that it sounds nice in principle.
Mm-hmm.
I think the public demands that the Federal Reserve try to do something
Mm-hmm.
to minimize the risks of another incident like a Silicon Valley Bank failing.
Mm-hmm.
But I think it ignores what were some of the key problems at Silicon Valley and Signature Bank that need more thinking.
Mm-hmm.
Uh, for example, how is it possible that financial institutions that are operating in such an unsafe and unsound manner are allowed to continue operating in an unsafe and unsound manner and should have not been forcibly pushed into fixing the problem
Mm-hmm.
beforehand? Not that that would have solved the specific runs, but how is it possible that federal agencies don't actually cooperate amongst each other? I'll give you a perfect example of this. I think that the average person who reads the Wall Street Journal could not tell you what the difference was between the Federal Home Loan Banks and the Federal Deposit Insurance Corporation. Wouldn't
Mm-hmm.
know what the difference really was.
Mm-hmm.
I think that that is lost in Washington and among people in the agencies that I've talked to.
Mm-hmm.
Like, it's not cool that at the end of the day, we say to the public, oh, look, the Federal Home Loan Banks never lost a dime because of their preferred interest in collateral.
Mm-hmm.
But similarly, it's not cool to say, oh, yeah, well, if Silicon Valley goes down, maybe the FDIC will come in. Maybe they don't. They only cover up to,
Mm-hmm.
$250,000. I mean,
Mm-hmm.
we want to allow too big to fail to not be too big to fail, but still
Mm-hmm.
maintain too big to fail theoretically.
Mm-hmm.
And I think that that kind of conflict is what becomes such a source of confusion for the public, becomes such a flashpoint politically in this country in terms of how we manage financial institutions. Now, I've been doing some research just to throw this in, and as you were
Mm-hmm.
asking me this question, I thought it's worth thinking about. So, if you're going to talk about a 5 or 10 day window during which a crisis could form,
Mm-hmm.
and you could have some way to manage it. I've been doing some research on Jerry Corrigan. When I
Mm-hmm.
worked at the Federal Reserve Bank, he was the president of the Fed. So I had some interactions with him in a staffer sort of way. But I've been reading through some of his papers, and one of the things that struck me was his comment about financial crises and how central banks need to deal with them. And he said that the main operating goal of a central banker in the middle of a financial crisis is to buy time.
Mm-hmm.
So if having collateral at the discount window in a classic run that was, say, happening with Washington Mutual or IndyMac during the financial crisis, if that was available and made it slightly easier to get liquidity, maybe that buys some time. Maybe
Mm-hmm.
that's a good idea. We could, however, talk about the consequences of extending that requirement well below the largest institutions to smaller, say, 10 to $50 billion
Mm-hmm.
institutions, or potentially examiners give guidance that all banks should have something like this.
Mm-hmm.
One thing I could tell you is that banks are saying, well, I'm concerned about the cannibalization of my collateral with the home loan banks, and I won't be able to really pledge it there because I'm going to have it pledged at the Federal Reserve.
Mm-hmm.
I could also tell you that the Federal Home Loan Banks are not exactly making it easy on their members to have collateral at the home loan banks that they then want to repledge over to the Federal Reserve.
Mm-hmm.
Um, it speaks to, again, dysfunctionality,
Mm-hmm.
lack of coordination, lack of communication, despite all the statements that they're going to do. Um,
And it
but
also seems like when you talk about the security interests, I think that's something people
Mhm,
often underappreciate, that the federal home loan banks, like you said, they are member-owned cooperatives, but there is a recognition, at least in the FDIA, that their security interests, like all security interests, come before the unsecured creditors.
mhm.
And so people often talk about it as a super priority lien or something, but it's really just they have a very good first security interest, and so they don't want someone like the Fed getting ahead of them in the discount when with the interest at the discount window. They don't want someone like the FDIC as subrogee of deposits getting ahead of them. Um,
Right.
and for politicians, that's fine because they're a private organization. So this idea that they have a windfall security interest or a total security interest, that doesn't get as much headline as if we talk about how the FDIC is funded.
Right. Well, I remember the FDIC is a receiver in bankruptcy of a bank,
Mm-hmm.
right? So you know that receivers have a right to deny even preferred claims.
Mm-hmm.
It would be one day very interesting if the FDIC really wanted to press its claim
Mm-hmm.
that it could reject the Federal Home Loan Bank to get paid.
Mm-hmm. Yeah.
We haven't had that.
No.
Nobody really wants to press the nuclear button. I think we
No.
just want to threaten it.
Yes. Yeah. But when you talk about that stacking of interests in the runway, I kind of also think about there can be the opposite problem that we saw with the recent failure of Republic First Bank in
Mhm.
Pennsylvania. That there you had a fairly small institution, 6 billion in assets, 4 billion in deposits, half of which were uninsured. And at least from what I could see, that bank was in trouble for a while, that it
Mhm.
was late having its financial statements for 2022 because of material weaknesses. It had ongoing lawsuits among its directors. It just seemed to have a lot of, at least from what I could see as an uninvolved external person, a
Mhm.
lot of problems. And I've been reading that over the last couple of years of its life, it became steadily more reliant on the discount window, the bank term funding program, and advances from the Federal Home Loan Bank system for its funding, such that when it failed, there were several hundred million outstanding to those creditors. Plus, there was another 2 billion or so in collateralized deposits, so secured interests of municipalities. And that's kind of why the FDIC took such a huge expected loss on it. So in that case, we waited hoping things would turn around, and they didn't, and now the FDIC has this big loss.
Well, I think people were playing for time to see if the bank could get acquired. The deal fell through. That's kind of what really triggered the final failure.
Mhm.
The fact that the institution got into the position that it did, even though asset quality has been generally strong, even though the economy is not in a deep recession, tells you something about the quality of this institution. And again, it raises the question, how come examiners are not addressing these institutions sooner?
Mhm.
Um, I think, you mentioned the home loan banks having advances to Republic First. I think that it gets back to the point I'm making that
Mhm.
I don't know if the home loan banks want the role of being able to determine the
Mhm.
members that can't pay. They are trying. They have to address what the FHFA has said. You cannot be a lender of last resort. You cannot look to the collateral as the primary means of payment. You have to see if the ability to pay. You have to test that. But I think that there's a lot of concern on their part,
Mhm.
legitimately so, that by denying an advance, they could actually precipitate exactly what, they could be the cause of a bank
Mhm.
failure. So uh, I think that there's going to be changes. I think they're going to be slow, and I think that at this point it's about how I don't mean to be overly cynical, but I think this is much more about playing to the public and saying we're doing something
Mhm.
than necessarily for sure finally knocking the nail, not locking down the last plank, and
Right.
being able to make sure that we don't have more bank failures.
Right. And the Federal Home Loan Banks also have something of an information asymmetry that, like you said, would make it not only undesirable, but hard for them to assess asset quality. That they're not examiners, they're not involved in monetary policy. they're not under the kind of the dome of the federal government. And so when you see things
But
like
they do have, Matthew, they do have a regulatory apparatus. It's called the
Mhm,
Federal Reserve, the
mhm,
state banking
yep,
commission departments, the
mhm,
OCC, the FDIC, a
mhm,
whole bunch of other regulators who are supposed to be coordinating and communicating with the federal home loan banks.
mhm,
Perfect example of this. Let's take the FHFA rule
mhm,
that no FHLB can lend to a bank with a negative tangible common equity ratio.
mhm,
I mean, that's in the rules.
yep,
1266, I think, is the section of the FHFA Act. So, um, okay. Now, what when the Federal Reserve changed the regulatory capital rules in 1994
mhm,
and went to risk-based capital requirements, and also made a change to say that banks should not include AOCI, mark to
mhm,
market in the bond portfolio, in their capital calculation, and
mhm,
then refine that to just under 250 billion in 2008.
yep,
This rule was never updated or changed by the FHFA.
mhm,
The FHFA continued to maintain a gap-based tangible common equity ratio. Now you might say, well, and given what just happened, good thing that they didn't. But that's not the point. The point is that when the FHLBs said, wait a minute, why do we have this capital requirement for banks for who we lend to, but the banks themselves report without the AOCI? Why can't all this be coordinated? Nothing happened
mhm, mhm,
for 20 years.
right.
So, so I have to sit there and think, you know, there's a lot of posturing around coordination, but
Mhm,
nothing ever gets done in Washington. Everybody has their own way of their own franchise, their own agency,
mhm,
and they're going to manage it their way with their rules. And
right.
I'm astounded. This is why you have the kind of problems that you do have, or at least one of the reasons why, I think.
Yeah. Well, on that topic of lack of coordination, I think that you also have some views on the recent merger proposals that there was the earlier one out of the OCC, the more
Mhm.
recent one out of the FDIC. I think we've kind of heard silence or less than silence from the Fed on they're not going to do one. Um, and despite the fact that the OCC principal is on the FDIC board, their proposals are different. What's your view on these incongruous proposals?
Again, it fits the same narrative which I've been trying to push, which is that there is lack of coordination among the agencies,
Mhm,
and there's more posturing in front of Capitol Hill than there really is attempt to fix that lack of coordination. And when the FDIC and the Federal Reserve reports on the failures of First Republic, Signature, and Silicon Valley came out last year, they all pointed towards the requirement that the home loans and the federal and the regulators need to be talking more. The
mhm,
communication needs to be improved. Um, and certainly there's more communication, but whether any information is passing through is still open to question.
right.
I keep pounding on that. I think
Yeah.
this is a good example of that. Like why,
Mhm,
if you have an umbrella organization like the FFIC, why, if everybody's supposed to be on the same page, why would you then release different kind of merger proposals, which by the way, only leave the constituents more confused, undermine the ability to have the mergers. And we were just talking about Republic First. Perhaps some of the problems around that merger. I'm not that familiar with the circumstance of it, but why it got called off. But perhaps some of the problems had to be regulatory problems.
mhm,
Shouldn't be that way. We should have a streamlined system.
yeah. Yeah.
By the way, just by the same token, it's very hard to get chartered for a
Mhm,
new bank in this country.
mhm, mhm,
Again, same problems.
yes. Yeah. No, I deal with it all the time in my practice of
Mhm.
trying to pick which state you're going to get seek a charter from. And then even if you pick a state that is open to it, well, which Federal Reserve district will you be in? And what's your likelihood going before the FDIC board based on its current or expected composition? And all of these are investments that are substantial for
Well, I
banks to
think
pick.
I think it's important to emphasize it's not a problem that we have different agencies. I mean,
Yeah.
institutionally, the Federal Reserve and the other regulators have always viewed the dual banking system where you have different regulators and you have
Mhm.
competition as a good thing, not a bad thing. That it would not it would you run the risk if there was one regulator of stifling innovation
Mhm.
because the regulator was against this when some other state regulator might be for it or other regulators. So, there's something to be said for that. All I'm saying is that, okay, that's true, but you need to coordinate.
Mhm.
Don't put me into a position where I'm doing X to satisfy this regulator, but running
Yeah.
afoul as a result of you.
Right. Right.
That's the problem. That's
Mhm.
what needs to be fixed.
Yeah. Yes, it is frustrating that these banks that want to get chartered and they sit down with a state who says, "Oh, we'll give you a charter for if you do X, Y, and Z," and then down the road they discover, well, the FDIC has a negative view of that state, and the FDIC is never going to give you deposit insurance if you're from that state.
Well, that's also leadership in Washington. We
Yeah.
need to have elected officials in the Senate and the House
Hmm.
who want to lead on these kinds of things and coordinate and pull the different agencies together
Hmm.
and craft legislation around that. But there is no such cooperation. There's no cooperation on a lot of topics, but certainly banking is the only issues around banking are preventing the next financial crisis, that not making a stronger banking system. And right now, by the way, the banking system only accounts for 20% of all credit in the US anyway.
Hmm.
So, it's a shrinking component of the overall capital markets. If we want to
Hmm.
continue to make banks irrelevant and become non-bank like Apollo and other private credit providers continue to get in on the act that what banks have traditionally done, we're working in that direction.
So can you tell me a little bit more about, while we have a couple minutes left, about the Bank Treasury Newsletter, that it is for banks? And can you tell us a little bit about where it came from, what kinds of topics it covers, stuff
Well,
like
I
that?
was an II rank bank analyst at Solomon Brothers when I came from I worked at the Fed. And then when I went to after I left the Fed in 94, I went to Solomon Brothers as a corporate bond bank analyst and I was publishing and I had a great time. And when I left that in 03 to go to the market side, it's then Citigroup, I wanted to have something that I could contribute, but I was in sales and sales from a compliance standpoint can't produce research. So I came up with this great idea to call my publication a Bank Treasury Newsletter. And actually, our economist, Bob DiClemente had this piece called Comments on Credit. So I wanted to call it Comments on Banks. But then I thought to myself, nah, don't do that. It's too, you have to come up with something else. And so that's how I developed it. And really it was, what did Ethan learn from talking to bank treasurers and CFOs and some of the CEOs that I met and board people in my travels every month? And I've
Hmm.
been doing this now for 20 years.
Wow.
And it's interesting writing something every month. You'd think you'd run out of topics. To be truthful, I've never gone through any month in 20 years where there hasn't been something really interesting to talk about that I wasn't talking about really about the month before. So,
Hmm.
yeah, it's pretty exciting.
That's great. Well, Ethan, I want to thank you for coming on Credibly Challenged. We really appreciate your time and thoughts. And also, I want to thank the listeners. Without you, we wouldn't have a reason to do these programs. As always, stay tuned for the next episode.
Thanks.